Hello to all TradingLink partners. We have once again arrived at our weekly trading sharing session. This week marks the second trading week of October, and it is also the week following China's National Day holiday. Let's take a look at the market movements. Due to the National Day holiday, some trading products experienced increased volatility. Let's first examine the crude oil futures market. Prior to the holiday closure, crude oil futures had been in a volatile consolidation near the lower boundary of the platform at $67 for 3 consecutive days. After the holiday, prices surged sharply, driven by geopolitical factors. We had previously mentioned focusing on long positions before the holiday, anticipating potential geopolitical events that could lead to sharp upward movements. Fortunately, crude oil futures formed a bottom near the lower Bollinger Band on the daily chart at $66.70 and then rapidly surged to $77 within 5 trading days, resulting in approximately tenfold returns. If one opened a position of 0.2 lots with $10,000 or $20,000 for 2 lots, they could have seen returns of about 20% in just 1 week, with the potential for even greater profits. This movement was within our expectations, and it was based on what historical data has shown us. Crude oil futures are a unique product, especially since China has its own crude oil futures contract, which is highly correlated with international markets. This correlation means that crude oil often sees significant market moves during major Chinese holidays, such as the May Day Golden Week and the National Day Golden Week in October. Over the past week, volatility broke through the average of the past 10 weeks, ranging from $66.70 to $75.60. What caused this surge? Looking at the historical charts, the trend during October is similar to that of May, when after the May Golden Week, crude oil opened with a significant gap down. Last year during the October Golden Week, crude oil also saw a sharp drop from high levels, opening limit down. Similar patterns were observed in previous years, particularly in May 2023, when we saw an exceptionally strong decline. These patterns have held consistently over the past decade, indicating that there are indeed 2 opportunities each year where profits can be easily made. This year's sharp drop, followed by a rebound from low points within the Bollinger Bands, was especially apparent. Customers who speculated on short positions during the holiday would have suffered significant losses, as pre-holiday short positions appeared deceptively strong. The trading volume on the day before the holiday was 170,000 contracts, with the previous day recording 220,000 contracts totaling over 400,000 contracts. Of these, at least 200,000 were short positions, leading to substantial losses in this rebound. Why do these large market movements occur during holidays? One reason is that many market makers in China's futures markets are also international institutions, often sharing the same positions as those in NYMEX. With such unique characteristics, we've learned from experience that both May and October present excellent trading opportunities. 1 lot of crude oil costs approximately 70 lots, and the margin for 1 lot of lead is 7.7 billion lots. A short position of 200,000 contracts could result in losses exceeding 10 billion lots. This demonstrates how extremely volatile and risky the crude oil market is. Now, let's review this week's crude oil market. The geopolitical situation caused a sharp price increase on Monday, with prices stabilizing after opening lower and rising above the 60-day moving average. By the end of the day, there was a strong surge, allowing traders to close positions with profits. Towards the end of the session, we saw a final upward push, which was the ideal moment to switch to short positions. Although there was a brief surge of about $1 on Monday morning, the market reversed quickly because domestic markets opened at 9 a.m., causing a technical pullback from the limit up. Market makers took advantage of this to reverse the long positions and initiate a short squeeze. TradingLink performed well during this period, as our traders accurately timed the market, taking advantage of the post-holiday movements. Following Monday's rise, there was a high probability of a pullback on Tuesday. This pattern is something we have observed repeatedly over the years. However, this week's overall performance was slightly unexpected. After taking profits on Monday, our traders chose not to re-enter the commodity futures market, as the rapid handover or continued holding of positions posed significant risks. The second week after such large movements tends to be marked by extreme volatility, with both upper and lower wicks on the weekly chart being unusually long. The current situation still reflects bullish momentum, with geopolitical tensions in the Middle East remaining unstable. Although Israel has already formulated a plan to retaliate against Iran, the extent of this retaliation remains uncertain, which has caused trading volumes to drop significantly over the past 3 days from 460,000 contracts to 290,000 contracts yesterday, down from the first day's volume of 630,000 contracts. When key market fundamentals, news, and decision makers are uncertain, it is often best to remain on the sidelines. Not every moment is an opportunity to trade, and waiting might be the best trading strategy. Looking ahead to next week, we expect the 5-week moving average to rise slightly, possibly reaching around $70.50, driven by Middle Eastern geopolitical developments. However, the upper resistance level on the weekly chart is not far off. Resistance at $80 has been established by previous highs in April $87 and July $82, creating a significant downward pressure line that started the August 9th decline. Now, let's move on to gold. The recent performance of gold has been quite challenging. From a technical perspective, it has been difficult to navigate, and the complexity has been high. Looking at the daily chart, gold has been in a high-level consolidation for 12 consecutive days. While we remain bullish in the medium to long term, this recent pullback seems to be a horizontal consolidation rather than a short squeeze. Last week, we were concerned about a sharp correction on a monthly scale, potentially with a decline of around 100 points. However, the recent decline has been more of a downward consolidation. Yesterday, the Bollinger Band midline on the daily chart showed a rapid rebound after breaking through the lower boundary, without any significant correction. The 4-hour chart also shows strong momentum, aligning with our medium to long-term bullish outlook on crude oil and gold futures. On the weekly chart, the correction has not been sufficient. Gold has been in a similar pattern for the past 4 months, without a full correction of the roughly $140 price range. Therefore, we believe that gold may continue to rise into next month, particularly around the U.S. election period, which is a critical juncture. Historically, U.S. elections have had a notable impact on gold prices. For example, when Trump was elected, gold experienced several months of decline after his victory. Market bears often time their moves around these key events. In the short term, we expect the bullish trend in gold to continue in the coming days, with a potential breakout above the $2,708 range. Many large hedge funds have already abandoned their long positions during this pullback, which aligns with the expectations of major players. After reducing positions, the market is likely to resume its upward trend. Next, let's look at the cryptocurrency market. Bitcoin is currently trading around $62,000, having risen to $64,000 before facing a sharp pullback. Last week, Bitcoin struggled to break through the upward resistance line formed by the highs of June and July around $66,000. We expect cryptocurrencies to experience a sharp surge leading up to the U.S. election, potentially pushing Bitcoin toward the upper end of its range, around $70,000. Whether Bitcoin can break beyond $70,000 and approach $80,000 or $90,000 will depend on whether Trump wins the U.S. presidential election. As many know, Trump's policies on cryptocurrencies have been relatively open and supportive, especially with his close partnership with Elon Musk, which would be a significant boost for cryptocurrencies if Trump is elected. Therefore, we anticipate a sharp rise in Bitcoin as the election situation becomes clearer. In the short term, the outlook for rapid gains is less favorable, but traders might consider taking profits during any quick rallies and re-entering at lower levels. Now, let's discuss the US dollar index. Last week, when the dollar index dropped to the key 100-point level, it experienced a swift rebound, causing North American short positions to close out quickly. This created a double top formation. In the short term, we remain bullish on the dollar and suggest maintaining positions, while the euro still has considerable downside potential. Finally, let's talk about China's shares market. The behavior of many trading products shows certain correlations and similarities. As we discussed earlier with crude oil, these connections help us understand why shares opened significantly higher after the holiday, only to pull back quickly. The reason for this sharp rise and fall can be seen by looking at the Mount Systems China A50 trading product. While XNES has yet to offer quotes for the China A50, we can observe the HK50 index. During the National Day holiday, the Hong Kong market saw a sharp rally in electronic trading, rising by more than 3,000 points. Similarly, China 50 futures in Singapore mirrored this performance, so a high open was expected for a shares on Monday, and indeed, they opened 10% higher. However, as often happens in such situations, the market quickly corrected after the opening. Many funds, particularly neutral funds hedging with stock index futures, faced margin calls due to this rapid market movement. The manipulation tactics used in the share market are quite similar to those seen in crude oil trading. Looking ahead, we remain bullish on shares, but patience is required. Once the correction is complete and the 5-week moving average recovers in about 3 weeks, we expect a significant breakout above the 3,674-point level, with potential for further gains. However, this won't happen immediately, so there's no need to rush. Overseas funds have not yet found the right entry point either, so we may see continued downward pressure next week. If you are holding long-term positions, even if you are stuck around the 3,500-point level, there will still be opportunities to recover and make a profit as the market rebounds. We are optimistic about the broader market outlook, though TradingLink has not allocated funds to physical shares. We are monitoring the A50 CFD contracts and may initiate positions if the market drops below 3,150 points next week. In summary, this week was one of the few where TradingLink's overall performance was not particularly ideal. While we didn't incur losses, the volatility in crude oil made it difficult to find favorable re-entry points after taking profits last week. In addition, we were stopped out of a gold position at 2,670 on Tuesday, missing the expected sharp drop. On Thursday and Friday, if gold could drop rapidly to the 2,500 level, we would have seen better results. This concludes our trading review for the week, along with the outlook for the next week. Thank you all for listening, and have a great weekend.